Hello everyone, here we are again back with Accounting for Partnership Part 3. Well, let's have a quick recap of what we did in our previous videos. In the first part of the video, we learned about the preparation of financial statements of a partnership firm. That is, first we learned how to prepare profit and loss appropriation account. In my second video, I had explained you the very first item appearing in the profit and loss appropriation account, and that is interest on capital, its accounting entry, valuation and the treatment. Today, I, Dr. Aarti Mudliar, Assistant Professor, Department of Commerce, the Bhopal School of Social Sciences, I'm here to explain you the interest on drawings. So my dear students, as we all know that all the partners would require some or the other amount from the profits of the firm for their personal purpose, which is known as drawings. Now, as we all know that the separate entity concept tells us that the owners and the business entity are two separate identities having a distinct entity, and therefore it is necessary for the firm to record all the drawings which are made by the partners separately in the books of accounts. Now, whenever the drawings are made by the partners for their personal purpose, some interest on drawings are charged, which is an income for the firm. So, as soon as the partners withdraw some amount from the firm would charge some interest on drawings on the partners, which will be paid by the partners to the firm. As I said, that interest on drawing is an income for the firm because they would be receiving this amount from the partners. Hence, it is shown in the credit side of the P&L appropriation account as increase in the net profit, and thus increasing the entire sum to be distributed among the partners or appropriated among the partners in these various ways. Well, before valuation, let us understand a little about interest on drawings. For the first thing, the partnership agreement may provide for charging of interest on the money withdrawn by the partners for their personal use. That is, it clearly says that if the particular about the interest on drawing is not mentioned in the agreement, the firm cannot charge interest on drawings on the partners' withdrawals. The second thing expresses the same thing, as you can see, that no interest can be charged on the drawings if there is no expressed mention in the agreement of the partnership deed. And therefore, in the deed, there should be a mention of the rate of interest on drawings to be charged by the firm on the drawings of the partners, and all the partners should agree upon it. The next thing is that it reduces the excessive withdrawal made by the partners. Well, of course, if the interest is charged on the drawings made by the partners, it curbs the abnormal withdrawal made by the partners. And there are various methods of valuating the interest on drawings, which we'll see in the further video. So for the convenience of understanding, I'm dividing the entire understanding of interest on drawings in two parts. One, the accounting entry, and the second part we'll be dealing with the computation of interest on drawings. So let us understand about the accounting entry. Well, as I said that it is an income for the firm, and hence this interest on drawings should be credited, and thus it reduces the capital of the partners. Therefore, for charging interest on drawing on the partners' capital, the very first entry would be partners' capital account debited to interest on drawings. Now, as this income is a nominal nature account, and therefore it has to be closed, and thus it is transferred to P&L appropriation account. So the very next entry for the transfer of interest on drawings to P&L appropriation account is interest on drawings account debited to P&L appropriation account. Well, if we combine both the entries, we get an alternative entry, and that is partners capital account debited to P&L appropriation account. Well, if we see the computation part, it is divided in two basic heads. That is, we need to observe the pattern of withdrawal of the partners. How are the partners withdrawing the amount from the firm? Whether it is a regular withdrawal and of equal amounts. By regular, I mean that the time period between two withdrawals should be equal or same. That is, it can be monthly, quarterly or 6 monthly. That is, in a regular fashion. Or it can be just the opposite of it. That is, it can be done on irregular time period. That is, the time period between two withdrawals will never be the same. One more thing we need to take care of is the amount withdrawn. Many a times it has been observed that all the partners will be of an habit to withdraw the amount of the same fashion. That is, the same amount, like for example, 5,000 amount will be withdrawn every month or maybe every quarter or maybe every 6 months. Whereas, if they withdraw unequal amounts, say 5,000, 2,000, 10,000 and sometimes 50,000 all of a sudden, then it makes an irregular and unequal amounts. So let us see the valuation of interest on drawings according to the pattern of their withdrawal. Well, coming to the computation part, let us understand how the computation or the valuation of interest on drawing is to be done. Well, for the valuation, we need to understand the pattern of withdrawal of the partners. Well, by pattern, we mean that either the partner would make a definite amount of withdrawal in equal time period. That is, the time period between the two withdrawals would be same, be it a month or a quarter or 6 months. And the amount withdrawn would be definite. It would be certain and fixed amount he will be withdrawing every month or every quarter or every 6 months. Whereas the second way or the second pattern would be the varying amounts withdrawn at different time intervals. That is, the withdrawal done by the partners between the two withdrawals, the time period will not be the same. So hence we need to observe these two patterns and accordingly we should valuate. Well, if we go for the fixed valuation, that is the fixed amount has been withdrawn at fixed time interval, then we apply the average period method. That is, in one single formula, we can calculate the interest on drawings made for the various withdrawals. Whereas, if we go for varying amounts of withdrawal, there are two methods which can be followed depending on the number of withdrawals done. Okay? So, we can apply either the simple method or else we can apply the product method to value for the varying amounts. Well, as I said that interest on drawings has to be calculated seeing or looking at the pattern. Where there can be one more pattern, and that is the lump sum withdrawal. Sometimes it won't be done regularly over a period of time, whereas a lump sum amount can be withdrawn. So that is what will be given to you in the question, that during the year a lump sum amount, say 50,000 or 30,000 has been withdrawn by the partner, but interest is to be calculated at the rate per annum. That is, the simple formula of calculating interest is what we have studied as interest is equal to principal into rate into time. Okay. In place of principal, we need to keep the total drawings amount. The rate will be provided to you in the question itself. That is the amount that or the rate that has been agreed upon in the partnership deed. But whenever per annum is given in the question, the time becomes very prominent or very important. Why? Because this rate is distributed over the year equally. And that is why we need to calculate the interest on the outstanding amount of the withdrawal done. If it is done on the regular basis, even then we calculate it on the average period method. Whereas if the irregular withdrawals are done, as I said, that two methods are available, and that are simple method and the product method depending on the number of withdrawals done. So let us find out how it is done one by one. Okay, let's take first method, that is the lump sum withdrawal done during the year. Whenever in the question it is mentioned that the partners or any of the partner has withdrawn an amount in lump sum. That is, the time or the date of withdrawal is not mentioned, but the rate of interest given is per annum. In that case, it becomes very important to understand this formula. That is, the total drawings is to be evaluated, or it will be directly given to you in the question as it is the lump sum thing. The rate also will be provided to you as per the deed. So we simply need to apply the rate, be it 5%, so 5 upon 100. And regarding this average period, what could be the average period? So when the time of withdrawal is not mentioned in the question, we need to take average period as 6 months. That is, during the year, in the middle of somewhere in the year, the withdrawal has been made. Thus, instead of taking any particular average period, we take it as 6 months. So, children, please understand it once again that if a lump sum amount has been given to us as withdrawal made by the partner, but the rate of interest is given per annum, in that case, the average period is to be taken as 6 months. So total drawings that is given to you in the question into rate upon 100 into 6 by 12. So simple method it is, right? We move to the next method, and that is the average period method, done when definite amount is withdrawn at regular intervals. As you can see here that in this method also the formula remains same. Of course, it is interest, so formula is going to remain the same. That is total drawings into rate into average period upon 12. But here the average period is very important to be valued. So what is average period over here? Let us see. The average period is nothing but months left after first withdrawal and months left after last withdrawal. And these two items are to be taken as an aggregate and divided by 2. Why? Because we are taking two items and on an average basis we calculate this period. Okay, so here I go again, that months left after first withdrawal and months left after last withdrawal is to be added and divided by 2 to get an average period. The total drawings valuation depends on the type of withdrawals done. If the withdrawal is done monthly, then the monthly withdrawal is to be multiplied by 12 to get the total drawings. If the withdrawals are done quarterly, then each withdrawal is to be multiplied by 4 to get the total per annum drawings. And if it is done half yearly, then it is to be multiplied, the withdrawal is to be multiplied by 2 only, because there are 2 6 months in a year. As we can see that the withdrawals can be done either monthly, quarterly or 6 monthly, and it can be done on a different manner. That is, it can be done on fixed dates, that is in the beginning of the month, in the end of the month or in the middle of each month. Similarly, for quarter or a 6 months also, the same pattern can be followed. That is, in the beginning of each quarter, in the end of each quarter or in the middle of each quarter, and likewise in half yearly basis as well. So let us understand, taking one example, that how are we going to calculate this average period. Let's take case 1, that is monthly withdrawals. Now this partner is withdrawing the amount every month. So let's take an example. Suppose he withdraws the amount monthly of 5,000 rupees. Okay. So how do we calculate the total drawings? Simply by multiplying 5,000 with 12, because he is withdrawing monthly. Therefore, the total amount of drawing should be 60,000. So I'm just putting here the total amount of withdrawal shall be 60,000. Now on the 60,000, we need to calculate the interest on drawings, and for this we require average period. As I said, the formula is the months left after first withdrawal plus months left after last withdrawal divided by 2. So let's count how it is to be done, and there will be 3 situations: withdrawal done in the beginning of the month, withdrawal done at the end of the month, and withdrawal done in the middle of the month. Let's take the first situation, that is the beginning of each month this partner is withdrawing. So the first withdrawal will be done on 1st of April, right? The very first month of the year and day 1, that is 1st April. So on 1st April, he must have withdrawn the first amount. So how many months are left from 1st April till the closing date, that is 31st March? Well, open up your calendar and count. Yes, it is 12 months. That is, from the 1st April to 31st of March, it makes 12 months. So months left after first withdrawal is 12. Similarly, what will be the last withdrawal date? Well, at the end of the year, that is in the month of March, he'll withdraw his last amount. And that will be done on 1st of March, because he is withdrawing on first day of each month. So from 1st of March till 31st of March makes just 1 month, that is March month. Now we need to add both the amounts. So 12 plus 1, that is months left after first withdrawal plus months left after last withdrawal, which makes 13 months, divided by 2 gives us the average period 6.5. Therefore, the formula is applied just like this: 60,000, which is total drawings, 5% is the rate of interest taken, and the average period is 6.5 upon 12. So let us calculate what will be the amount. Alright, so on 60,000, we calculate at the rate of 5%, And for how many months? 6.5. Yes, you're right. 6.5 divided by 12. And here we have the answer, interest on drawings, and that is 1625. Although he had withdrawn 12 times in a year, but we calculated interest on drawings in one go with one formula itself. Let's look at if he withdraws the amount at the end of each month, then what change would occur in the valuation of average period. So let us take the second situation, that is in the end of each month he is withdrawing money. Let's keep the same amount, that is withdrawal is done of the same amount, 5,000 rupees. So the total drawings would be 60,000 only. So we are not again calculating that what is the total drawings. Let us focus only on the average period. Okay, so the formula remains same, that is months left after first withdrawal and months left after last withdrawal. So let's count. The first withdrawal might have been done on 30th of April. Why? Because in the very first month of April, he'll be withdrawing at the end of the month, which is 30th of April. So from 30th April till 31st of March makes 11 months, isn't it? And the last month would be 31st of March. So from 31st of March till 31st of March only makes 0 months. There are no months left after last withdrawal. Okay, so we will be adding the months left after first withdrawal and the months left after last withdrawal, that is 11 plus 0 divided by 2, and that will give us 5.5 months. 5.5 months on this average basis the interest would be charged. So let us again see 60,000, which is the total amount of withdrawal, the rate of interest remaining same, and the average period now has been reduced to 5.5 months. Divided by 12 gives us the interest on drawings, that is 1,375. Did you see the magic? Why is it done so? Why the interest amount has reduced? Earlier it was 1625 and now it is only 1375. Why it has reduced? Because for the first month interest on drawings would not be charged because he did not withdraw in the very first month. At the end of the month only he had withdrawn, right? And the same fashion, he did not withdraw in the beginning of the last month, whereas he withdrew at the end of that month. That is why we take an average period time. Now let's see what happens if he withdraws in the middle of each month. Let's look at this third situation, that is, what if he withdraws in the middle of each month? So let's count again. If he withdraws in the very first month, that is April, the date of withdrawal will be 15th of April. And thus, from 15th of April till 31st of March, the number of months would be 11.5 months. Similarly, if he withdraws in the last month, which is March, and on 15th of March, because middle of the month is 15th of March, so how many months are left? Just half a month. So let's add both the amounts, which is months left after first withdrawal, months left after last withdrawal. 11.5 plus 0.5 gives us 12. And 12 divided by 2 will give us 6. I'll tell you a magic. Whenever the amount is withdrawn in the middle of any period, that is middle of the month, middle of each quarter, or middle of 6 months, the average period will come always 6 months. Okay? So again the formula remains same, that is 60,000, the total withdrawal at the rate of 5% for 6 months, and the amount of drawings and the amount of drawing is 1500. It further reduced, right? Now let us look at the quarterly withdrawals. That is, in a span of 3 months, he is withdrawing the amount, the partner is withdrawing the amount 4 times in a year, right? And the same way it will be done, the valuation will be done for the average period. Okay, so let us take the example, or this situation is in the beginning of each quarter. So how the valuation is to be done if the amount is withdrawn in the beginning of each quarter? So let's again count. Okay, so first quarter is from 1st April to 30th June. So beginning of each quarter means 1st April 1st July, 1st October and 1st January. These would be the dates of withdrawal, right? Beginning of each quarter. So the first withdrawal is done on 1st of April. From 1st of April till 31st of March, the number of months are 12 obviously. But the last withdrawal, the quarterly withdrawal, will be done on 1st of January because the last quarter starts from 1st of January and ends at 31st of March. So the last withdrawal has been done on 1st of January and thus giving an outstanding months of 3, right? So let us add both the amounts, that is months left after first withdrawal and the months left after last withdrawal, that is 12 plus 3 gives us 15. 15 divided by 2 gives us an average period of 7.5 months, right? Let's do the calculation once again. But here the change is, since we had taken the amount of withdrawal to be 5,000 only, and this time he is withdrawing only 4 times in a year. So what will be the total drawings? 20,000. Yes. So let's calculate the interest on 20,000, which is nothing but 5,000 into 4. The rate of interest remaining same, which is 5%, and the average period is 7.5 divided by 12. So here we go. The interest on drawing is 625, just 4 withdrawals. Therefore, the interest would be lesser, right? Let's see the second situation, that is if the withdrawal is done at the end of each quarter. Now we know that what are the end months, the last months of each quarter. So the last month of first quarter would be 30th of June, the last date, that is 30th of June. Second quarter would be 30th of September. Third quarter would be 31st of December. And last quarter is 31st March. These are the end dates of each quarter. And now he is withdrawing on these end dates. Alright, that means the first withdrawal will be done on 30th of June. From 1st April to 30th June, that is the first quarter ends on 30th June. So from 30th June till 31st of March, the number of months are 9. And the last withdrawal would have been done on 31st of March because the last quarter starts from January and ends on March. So the end of last quarter, Q4, is 31st of March. Now from 31st of March till 31st of March gives us 0 months, 0 outstanding months. Thus, we have months left after first withdrawal as 9, months left after last withdrawal as 0, which gives us 9 divided by 2 is 4.5. So let's see what is the amount of interest. So again on 20,000 at the rate of 5% for 4.5 months we calculate interest, and that gives us an amount of 375. Alright, why? Because the last quarter had gone blank. No interest was charged for the last quarter because the withdrawal was done on 31st of March. Let's see for the middle of the month as well. Okay. Now, in the middle of each quarter, if the withdrawal has been done. So, what will be the middle month for the first quarter? From April to June, the middle month is May. And the middle of this month as well would be 15th of May. So, let's count from 15th of May till 31st of March, which gives us 10.5 months. Right? Similarly, the last quarter is from January to March. The middle month is February and the middle date is 15th of February. So from 15th February till 31st of March, it gives us 1.5 months. Let's find the sum of months left after last withdrawal. First withdrawal, which is 10.5, months left after last withdrawal 1.5. Again, it gives us 12 divided by 2 is 6. See, I already told you that if it is middle of any pattern, you will always get an average period of 6. So let's calculate it for 6 months. So 20,000 into 5% for 6 months would be 500. And just the same way it will be done for half yearly withdrawals as well. That is beginning of a half year, end of a half year and middle of the half year. Okay, let's quickly see. Beginning of half year will be 1st April and next beginning of the half year will be on 1st of July. Okay, it will be 1st of July, beginning of next half year. So months left after first half year is 12 months. Months left after last half year, that is the second half of the year, is 6 months. If he withdraws in the beginning of each 6 months, okay? So the sum of these two is 12 plus 6 divided by 2, which is 18 divided by 2, and giving us the average period of 9. Okay, so quickly let us calculate it. Now the amount remains same. So what will be the total drawings? 5,000 multiplied by 2, because he has withdrawn twice in a year only, because he is withdrawing every half a year. So let us calculate the amount on 10,000 at the rate of 5% for 9 months out of 12, which is an average period. 375 is the total amount of drawings. Let's quickly see if he withdraws at the end of each half year. Well, if the valuation is done at the end, what will be the end of a half year? 30th of June. The first half ends on 30th of September. Sorry, it ends on 30th of September. So months left after first withdrawal, that is from the end of the first half a year, from 30th of September till 31st of March, gives us 6 months, and the last withdrawal will be done on 31st of March itself, leaving no months in hand. So 6 plus 0 divided by 2 gives us an average period of 3 months. Let's quickly calculate the amount on 3 months itself. So 10,000 multiplied by 5% for 3 months, just 3 months, okay? The interest would further reduce. Why? Because for the last half a year, interest has not been charged. The same goes for the middle of the year, middle of a half year, that is. So if it is done in the middle of each half a year, so let us calculate what would be the date. What would be the date? The first half year, the middle of half year would be 30th June, okay? Why? Because first 3 months ends on 30th of June. So from 30th June till 31st of March, the outstanding months are 9. Whereas in the second half of the year, in the second 6 months, the middle date would be 31st of December. The next 3 months would end on 31st of December. So from 31st of December till 31st of March gives us just 3 months. So 9 plus 3 by 2 gives us 6 again. As I told you that if it is middle of any pattern, then you will get an average period of 6 months only. Let's quickly do the last calculation of this method. That is 10,000 into 5% for 6 months gives us 250. Alright, so every time you must have observed that different amount of interest has been calculated in just one formula. We did not do the valuation of interest for each withdrawal separately. There is no need to do that. But if we go for the next method, that is, if we go for irregular amounts and at irregular time interval, then we follow two methods. So let's quickly see how the simple method is applied. Well, my dear students, the simple method is adopted when the number of withdrawals are lesser, but the amounts are different and the time period between the two withdrawals is unequal, right? So as we can see in the example that the first withdrawal was done on 30th of June, whereas the next withdrawal was done on 1st of December. The time period between the two withdrawals are different and just 2 withdrawals were done in a year. So we can calculate the interest separately on each withdrawal. As simple as that. The formula remains same, that is the total drawings multiplied by rate upon 100 multiplied by outstanding months. This time we are not calculating any average period. Directly the time period can be seen. So from 30th of June till 31st of March gives us 9 months. The months outstanding are 9 months. So the formula applied here is 40,000 multiplied by 5% interest rate multiplied by 9 by 12. No averaging. Okay. So simply for the outstanding months, it is calculated 40,000, 5% for 9 months, right? And the amount is 1,500. Let's do the same calculation for the next drawings. The next drawing was done on 1st of December. Now from 1st of December till 31st of March gives us 4 outstanding months. The amount of withdrawal is 60,000, therefore the 5% rate of interest shall be applied on 60,000 and just for 4 outstanding months. Okay, so let's see how the calculation is done. It is done 60,000 on 60,000 at the rate of 5% for 4 months, right? And the answer is 1,000. Simply add both the drawings, you will get the total drawings in a year. So for this partner, the amount of interest on drawing is 2,500. We did the calculation separately. Now let's see the next method, that is if the varying amounts are withdrawn at unequal time interval but the number of withdrawals are more. Okay, in that case we go for product method. So we make a simple tabular presentation, that is the date of withdrawals, the amount of withdrawals and the outstanding months. How it is to be calculated? That is from the date of withdrawal till 31st of March we need to calculate the outstanding months. The last column we make for product, that is the product of drawings and outstanding months. That is why D into O, drawings into outstanding months. So we have taken an example where 5 withdrawals were done. Each withdrawal, as you can see, is of different amount and the dates are also not showing us any regular pattern. The first withdrawal was done on 1st of April of 20,000. So outstanding months from 1st April till 31st of March would be 12. If the withdrawal is done on 30th of June, that is just after 3 months, 42,000 was withdrawn. So from 30th of June till 31st of March, the outstanding months are 9. The next withdrawal is done on 31st of December. Okay, so from 30th of June till 31st of December is a duration of 6 months. The first difference was 3 months and next difference is just 6 months. Unequal time interval. This amount is 15,000. So outstanding months from 31st of December till 31st of March is 3 months. The next withdrawal is done on 1st of Feb. So from 31st of December till 1st of Feb, how many months are there? Just 1 month, January month. Okay, so that means pehle dekhiye 3 months, then 6 months and then 1 month. Within 1 month they have withdrawn. So unequal pattern you need to observe and then you need to apply. So 8,000 has been withdrawn now from 1st of February till 31st of March, just 2 months, February and March, 2 months outstanding, and the last withdrawal has been done on 31st of March itself and no months are outstanding for this particular amount. Now the next step is to multiply the drawings with outstanding months. So this gives the product 2,40,000, 42,000 into 9 gives us 3,78,000, 15,000 into 3 gives us 45,000 and likewise we get the product. For last withdrawal, why are we getting 0? Because no interest shall be charged on the amount that has been withdrawn at the end of the year. Let's find the sum of it. Okay, so we find the sum of all these products. Now comes the role of the formula. Now with one single formula, we will calculate the interest. Now the formula for interest on drawing is sum of products, that is summation of the entire products that we have calculated just now, multiplied by rate upon 100, which could be any amount that is given in the question, multiplied by 1 by 12. And by applying this formula, we can quickly get the answer. So let's put all these calculation in our formula. Okay, so I'll apply this now. In place of sum of products, I'll write 6,79,000. Let us assume the rate is 5% and then multiplied by 1 by 12. So let's see what is our answer. 6,79,000, 5% divided by 12, or to make it even clear, we can multiply it by 1 divided by 12 this way. And now we have the interest on drawing in one go itself. So I hope you all have understood all the various methods of calculation of interest on drawings, that is the lump sum method, the average period method, that is when the regular withdrawals are done at equal time intervals and irregular withdrawal are done at unequal time periods. If you have any confusion, repeat the video and watch it carefully and understand the calculation of interest on drawings and its accounting entry. Till then, keep safe, keep healthy. Bye-bye.